Hey everyone. In this video, I'm going to be showing you three Canadian ETFs I'm looking at, and I'm going to pick one to invest in. I'm going to walk you through my thought process, what it is I'm looking for in terms of making my decision to invest in it. So the three ETFs I pulled up are over here. One of them is by BlackRock, and two of them are by Vanguard. So for the BlackRock one, the ticker's XIC, it's the iShares Core S&P TSX Capped Composite Index ETF. Okay, so iShares is just the branding for BlackRock. Core just means it's one of those. It's also a branding thing by BlackRock. It just means it's part of your core portfolio. So S&P is the index creator. So they create indices, and the TSX is the Toronto Stock Exchange. So S&P TSX Composite Index is the index that represents it's a good gauge of the Canadian economy. Okay, so capped means, you're going to see this elsewhere. Cap just means it caps a company in terms of its influence in an index or a fund. So just in case it gets really, really big and say it triples in size, let's just imagine Amazon tripled in size or Google tripled in size. It would be a pretty big influence, a fairly big representation in an index, and they don't want that because they're like, well, this is way too much influence from one company. They don't want that, so they just cap it. They're like, okay, well, we're only gonna allow one company, like individual companies, to represent up to, say, 3% or 5% of the overall index. So that's what capped means. So looking down here, XIC, why this ETF? Well, you get to own the entire Canadian stock market. It's low cost and it's a long-term core holding. And right here, it says it's looking to replicate the performance of this exact index. Okay, so going down here, the MER, the fee that you should always be looking out for, is 0.06%. That is really, really cheap, so that's great. And then these are the holdings. Okay, so it shows the top 10 holdings. So you have the Canadian banks, the big banks, Enbridge, CNR, Brookfield Asset Management, another financials company, energy companies, the telcos, BCE. So that is, this is the top 10, like the top 10 holdings are these companies, and there are a total of, because it's the S&P TSX Composite, there should be 240-ish companies. So 240 of the largest Canadian publicly traded companies, that's what the S&P TSX Composite is, okay? So that is that. For this ETF, this is the FTSE Canada Index ETF by Vanguard. So FTSE is another index creator. So S&P is one of them, FTSE is another one. And this fund, this ETF, the MER is 0.06%, so it's the same. And this one, it invests primarily in the largest Canadian stocks. So you can imagine that there would be less holdings here. So if we go down, right here, 58 companies, okay, versus this, the TSX Composite Index, 240 companies, okay. So here, because the focus is large companies, okay. So again, if we go down to the top 10, we see the same, more or less the same companies. And then down here, you can see, well, 42% of it is in financials, about 18% of it is in oil and gas, industrials, materials, basic materials. Canada is a resource-heavy, resource-based country, okay? And then we have our big banks. So, and then our telecom companies. So this is the weighting and what kind of sectors are this fund is invested in. So this is VCE, okay, large Canadian stocks. If we go over to FTSE Canada All Cap Index ETF, so VCN, again, FTSE, index provider, all cap. All cap means they're going to invest in large, medium, and small Canadian companies. Okay, that just refers to the size of the company. And so we can imagine that there's going to be more holdings. So here, 208 companies. So more than this VCE, a little less than the TSX the composite index. And of course, top 10 holdings, identical to this one. So why would I want small, medium companies in as part of my investments? Well, small and medium cap companies can exhibit higher growth, capital gains, right? A small, medium cap company, small, medium-sized company is more likely to double or triple versus a company like RBC or TD or CNR because they're already massive. Now, why would I not want to invest in just the large companies? Well, the large companies, because they're more established, they're more profitable, they will pay a higher dividend. So over here, distribution yield, okay, this is the dividend, 3.54%. Okay, this is for the VCE, the one that invests primarily in large Canadian stocks, versus the all cap one. You can imagine the distribution yield, the dividend payout will be less, and it's about 3.14%. So this one has a good balance of, you know, having big companies in the portfolio, in the fund, but also getting exposure to small and medium-sized companies where there's potential for price appreciation, for gains. Okay, so one more thing I want to point out, you can see here the top 10, okay, which is identical to this one, the top 10 right here. So for the large, for this fund that invests primarily in large companies, the top 10 represents about 50% of this overall fund, this index, this fund, okay? Whereas here, for the all-cap one that includes small and medium-sized companies, it represents about 39% of the fund. Okay, so about a 10% difference, but again, because this ETF this index holds small and medium-sized companies. So I want exposure to the small and medium-sized companies. I think it's a good balance between getting some dividends, getting a dividend payout, but also getting exposure to the small and medium-sized companies. I want the growth there. And so that will be my decision. That's what I want. I want dividend, combination of dividend and exposure to small and medium-sized companies. So I will be investing in VCN. So how come this one and not the TSX Capped Composite Index? Well, again, the TSX Capped Composite Composite Index represents 240 of the largest companies, Canadian publicly traded companies. So it does exclude some small companies as well. So again, VCN will be my first choice. Remember, small companies, medium-sized companies, they may not necessarily be profitable, but their growth potential will be much more significant, higher risk, but again, potentially higher return.